And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich.
Ever wondered how to transform $100 into $1,000, $10,000, or even $100,000 with only $100 in your pocket? Unfortunately, this is not a subject that is taught in schools. In retrospect, it would have been really cool if they had. Due to their ignorance, most people find starting an investment portfolio to be somewhat intimidating. But in today's video, I'm gonna reveal 9 of Warren Buffett's investing secrets that only rich people know and apply. I'm not saying becoming rich is easy, but by taking calculated risks, you may not be able to make a multi-billion-dollar fortune like Warren Buffett, but you'll be able to grow your wealth over time. Want to know the best part? You just have to watch this video till the end, and I'll share with you exactly what you need to do. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Buffett's point here appears simple, but it's deceptively complex. Of course, as an investor, you wanted to profit from the market, but one of the best ways to do so is to avoid losses. When you eliminate decisions that expose your portfolio to loss, what remains is more likely to be a gain. When you have more money in your portfolio, your gains compound even faster. This approach has implications for how you invest. Buffett's quote implies that instead of seeking the greatest possible upside, you should seek to avoid loss first and then consider gains. That is not the mindset of investors who see the stock market as a slot machine. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Buffett suggests that when you see an opportunity, you should act quickly and decisively. When the odds are stacked in your favor, such as when stock prices are significantly lower, you must invest heavily because good prices may not be available again for a long time. When markets are significantly down, Buffett frequently takes this approach. During good times, he accumulates a large amount of cash and then invests aggressively when stocks fall. He can use this strategy because he has a large amount of safe cash on hand. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. While some investors believe that investing is primarily about numbers, Buffett believes that investing is primarily about investor behavior. When investors become greedy and drive stock prices skyward, Buffett becomes concerned that a market crash will soon follow. When investors flee the market or a specific stock, Buffett becomes more interested because prices are lower. When stocks are cheaper, they do not carry the same level of risk as when they are more expensive. This is how Buffett considers avoiding losses. The market crashed in early 2020. Despite the fear, some investors jumped into the market, and the market rallied furiously off its lows. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett advises value investors to purchase wonderful companies instead of just the cheapest ones, those with higher economics and competitive advantages. The fact that great firms almost never appear inexpensive, in contrast to fair companies, may contribute to this problem. However, a business with a strong competitive edge is more likely to generate money over the long run and can save you from making a costly purchase. A fair business could falter and never return to your purchase price or above it, which might not be the case. In a similar vein, Buffett has long been a shareholder in Bank of America, a financial institution with location all over the country and a prestigious deposit franchise. It has the second largest investment in Berkshire Hathaway's portfolio as of the second quarter of 2022, and the stake is valued at more than $32 billion. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. Once more, Buffett discusses the need for temperament above intelligence for a successful investor. Investors should evaluate what is happening in the market, independent of who likes what stock, as opposed to attempting to follow or go against the majority. Investors can choose better options by focusing on objective data and making selections that are largely free of emotion. The stock market is a no-called-strike game. You don't have to swing at everything, you can wait for your pitch. One of Buffett's most well-known quotes captures the idea of seizing the moment. You don't have to invest until you come across a chance that appeals to you and satisfies your criteria for possible profit for the risk you're taking. Once more, Buffett recommends investors to hold off on making a purchase until they discover a chance that is unlikely to result in a loss. You are not required to gamble on a stock that you don't find alluring. If you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds. Buffett has long suggested that rather than attempting to choose individual firms, investors should utilize index funds to invest in the market. By choosing specific stocks, you are competing with the experts who have significant company knowledge. Contrarily, if you invest in an index fund based on the Standard & Poor's 500 indices, you would own the market, which is the benchmark that investors are striving to surpass. Don't hesitate to invest if you love it. But for the most part, index funds and staying away from stock trading will benefit most investors. Another benefit of utilizing index funds is the quick diversification that lowers risk. You don't get paid for activity, you only get paid for being right. There are always plenty of stock market experts and pundits prepared to advise you about how to best manage your finances. Buffett warns investors that being a frequent trader who continuously changes positions won't likely result in high profits. In the realm of investing, activity might appear to be productive, but ultimately, only the accuracy of your analysis counts. After all, you only find out who is swimming naked when the tide goes out. Investing might occasionally seem simple. Long-lasting bull markets are possible, and rallies may be ferocious. Buffett, however, argues that we only discover who is truly shielded and equipped to weather the storm when times are rough. Buffett has occasionally come out as out of touch with the times through the course of his career as an investor. But eventually, the situation changes, and people who earlier appeared intelligent are found to be swimming without their swim trunks on. Always check to see if your portfolio is set up to withstand a bad market. Even though Warren Buffett may be one of the most successful investors ever, many investors, even those who don't want to spend a lot of time in the market, may benefit from following his investing strategy. Focus on putting Buffett's teachings into practice, and you may significantly raise your net worth or become wealthy yourself. And that's it for today. Subscribe and become wealthy.